Gold revaluation is a different thing. James Rickards talking about revaluing it to 24,000, or Luke Gromen said they'd let it go up to 7 or 8,000. Not only that, you don't have to, print so much money because it is an accounting gimmick through the Federal Reserve and the Treasury. But gold-backed treasuries to this day still is the best idea.
The chart at the end of closing would have been that $100 over the 54 years would be 112,274.
All commodities. China owns the LME, the London Metals Exchange, which is base metals.
Yeah.
They value commodities, and you will see all of this gold that's moving from west to east, to me, is less gold moving from west to east and more a paper price setting mechanism in the west moving to a physical delivery mechanism in the east. That's why Hong Kong created a system to set price, because they don't want to be reliant upon the LBMA and the CME group, because they know it is in silver something in the neighborhood of 200 times the amount of silver that is available for delivery is traded every day. What could possibly go wrong?
Is the gold revaluation still on the table? I know that there were probably a lot of people that had some disappointment that there was nothing announced.
I want to talk about
on
that
the anniversary.
too. First of all, I talked less about a revaluation. I said that, I thought that they would let it rise organically and maybe market to market. And there are people who are convincing. James Rickards talking about revaluing it to 24,000, or Luke Gromen said they'd let it go up to 7 or 8,000 and then revalue it. Perhaps maybe that means market to market. But I did believe, and I still do believe, that Judy Shelton's idea is the best I've ever heard. And, what I did say, and I always gave her credit for it, I got some heat on X for it. And the person said, well, you didn't mention Judy in the snippet. I'm like, it's a snippet. And I checked with AI. Her name was mentioned 7 times in the video. And I always have given her credit. Look, when the former nominee to the Federal Reserve and Trump's advisor, in 2 interviews, one with me, one with Michelle, in a best-selling book right over here that I have, that I read, and in her X page, and on every interview, more or less says in no uncertain terms, Trump loved the idea, and she believed very strongly that he would potentially issue them on July 4th. When I was asked by Michelle a week before, I said 50-50 chance. I'm disappointed. It doesn't mean it's over.
Markets shrugged because nothing happened, but failed expectations often reveal more than successful announcements. Roughly half the market expected a July catalyst, yet according to Andy Schectman, delayed action doesn't invalidate the broader monetary direction. Investors should question why official gold policy remains opaque while sovereign accumulation continues worldwide. Missing one date matters far less than missing a structural shift in monetary strategy. Next, Andy Schectman exposes why timing may matter less than the mechanism quietly taking shape behind the scenes.
Gold revaluation is a different thing. I think that ultimately, first and foremost, they should market to market. It's valued at 42.22.
It's so stupid.
Revaluing it is something that I actually believe could happen, but I felt that it was too early for it to happen. I didn't think it would be revalued on July 4th. Ultimately, still may be revalued. And, you look at what's happening in Hong Kong, it may get revalued just by the market having a new price setting exchange that actually is focused on immediate delivery instead of futures, where you'll have competition for real price setting. But price revaluation, sure, it has happened. It could happen. A lot of people talked about it. It makes sense. It would do a lot if revalued high enough to help. It's an accounting gimmick.
And I think that there might...
I don't think it'll happen if it does until gold is much higher. And then I could see it.
Yeah. And I think that there needs to be some things in place in order for it to happen. I think that the audit for, Fort Knox needs to be done. I think that we need to know exactly what we're sitting on or 100%. What we're not sitting on.
Do we need to know? The world needs
to know, right? I mean, it's been since, 70 years since the last audit?
I thought Luke Gromen had the best take on it. He said he believed they would let gold rise organically to 6,000 or 7,000 and then potentially revalue it from a higher point.
Right, strength.
Right.
A new physical pricing hub can reshape markets long before governments announce policy changes. What Andy Schectman is highlighting is that Hong Kong's delivery-first model challenges decades of futures-driven price discovery without requiring an official gold reset. If physical demand keeps overpowering paper pricing, portfolio risk changes faster than most investors expect. Next, Andy Schectman reveals why a Fort Knox audit could become more consequential than any headline revaluation announcement.
Not only that, you don't have to, print so much money because it is an accounting gimmick through the Federal Reserve and the Treasury. But the gold-backed treasuries to this day still is the best idea I've heard, and I think it's not a dead in the water issue. But it just goes to show anytime you focus on a date, it's a bad thing. I did talk about it a lot, but I never said it was guaranteed, and I said I hoped it would happen. And so I was just as disappointed as everybody else.
I know. And look, there's a lot of things, and we talk about, and the one thing I wanted to get to, because we keep talking about, and I think it's such an important aspect, is Asia, and it's China. And the thing that I wanted to show you, and I don't know if you had seen it, it was a snippet that it was actually an article, but they actually put Ed Steer's charts that he put on here, and I don't know how we can get it on
Those
here.
charts are from Nick Laird, I believe, who's awesome. I got to re-up.
So basically what it says, how do I do this? Why is this?
Just disappeared.
I know, it's just.
You're usually pretty good with
I know,
this.
it's coming. There we go. Okay. So basically, I'm going to paraphrase it, but it says in the first chart, it shows what happened if you put $100, if you bought at the 10:30 in the morning time, gold priced in London.
History repeatedly punishes investors who anchor their expectations to political dates instead of monetary trends. Andy Schectman's argument suggests the real story isn't whether July 4th passed quietly, but whether Asia continues gaining influence over global gold pricing. That shift unfolds gradually, making it easier for most investors to dismiss until the evidence becomes impossible to ignore. Patient positioning often outperforms emotional reactions to missed milestones. Next, Andy Schectman unravels a decades-long trading pattern that raises uncomfortable questions about who has truly benefited from Western price discovery.
And then sold it at 3 p.m. at the gold fix starting on the first day of January 1970, and then reinvested the $100 plus or minus any gains or losses the following day at the morning gold fix, and sold it again at the PM gold fix.
Yep.
If you did that every day, every business day for 54 years, the initial $100 investment would be worth $6.97 today. Now, that doesn't include your loss due to currency debasement over the time. So in other words, you lost everything. The second chart, which you can't believe, you cannot believe this shit. So the second chart, we'll put this up somewhere so everyone can see it. Basically, it says if you invested $100 in the afternoon gold fix in London, where then the early in the Far East Globex trading session overnight, and then sold it in the morning when basically London was closing, the chart at the end of closing would have been that $100 over the 54 years would be $112,274.
I did a speech a long time ago and used a chart from a guy named Dimitri Speck. I just saw him on X. He's still around, but Dimitri took a chart. He made one graph of 10 years and all the market action in the 10 years, and it would show the price at the AM fixed drop like this, and at the PM fixed drop like this. As it would head to New York, it would slant down, and then as New York closed, it would start to move up through Asia into, and then the same thing would repeat. In other words,
if a market repeatedly rewards one region while punishing another for decades, that deserves far more scrutiny than daily price swings. This is where Andy Schectman's thesis shifts from short-term volatility to structural pricing behavior that appears remarkably persistent over generations. Whether driven by market structure or participant behavior, investors should ask why gains consistently emerge during one trading session and disappear during another. Ignoring long-term patterns has historically been expensive. Next, Andy Schectman reveals why this geographic imbalance may be accelerating as physical demand increasingly migrates east.
This is not how markets work, first and foremost. And it was 10 years worth of data in one chart. And there was another chart that I would show that a guy who used to work for me, he took every Sunday graph from Kitco for like 200 Sundays. I don't know how he did it, but 98% of the time on Sunday, the market would open up lower as it would come into
the U.S. futures, right?
Yeah.
So basically, the World Gold Council called Asia the engine of price support, and it basically says that during Asian trading hours, if you took what the price of gold has done this year in the first half, During Asian trading hours, gold is up almost 13% in the first 6 months. And during North American trading hours, we're down 15%.
Yeah, and what that basically says is that we've been feeding the East all of their gold at
Everything.
subsidized prices,
Correct.
and they're beating us at our own game. That's what you need to see, is that they value gold, and that's why you're seeing exchanges being set up in Asia that value gold appropriately, and not just gold, all commodities. China owns the LME, the London Metals Exchange, which is base metals.
Yeah.
They value commodities, and you will see all of this gold that's moving from west to east, to me, is less gold moving from west to east and more a paper price setting mechanism in the west moving to a physical delivery mechanism in the east.
Most investors watch the gold price but overlook where the strongest buying pressure actually originates. Andy Schectman notes that Asia's trading hours continue generating positive returns, while Western paper markets often suppress momentum, reinforcing a long-term shift in price leadership. If physical metal keeps migrating eastward, portfolio diversification becomes a question of purchasing power rather than speculation. Wealth preservation increasingly depends on recognizing where genuine demand resides. Next, Andy Schectman exposes why paper pricing may be approaching its biggest credibility test in decades.
In other words, where delivery and price are associated with immediacy, not the future price where the tail wags the dog. This is the dog wagging the tail.
Yeah, well, we're seeing that. And this is the question that he has right now. So Rick Whelan, 3876, says, when does COMEX become irrelevant? And I think that was a big topic at the symposium. Right now, I think they are irrelevant. I think that the one thing that you need...
And that's why whoever is standing for delivery perhaps isn't draining and leaving it in the eligible category, because it would blow up the system quickly.
And right now, they love the system.
Right.
Who doesn't love the system? When they're pushing it down, they're buying all the metal cheap.
That's right. That's the distinction.
Yeah, but it is, because Andy always talks about it. It can't be relevant if there's no trust. And that's really what it is. So I think that a lot of people have lost the faith and trust in the system. And that, I think, right there and then says that the COMEX currently is irrelevant.
That's why Hong Kong created a system to set price, because they don't want to be reliant upon the London LBMA and the CME group, because they know it is, look, in silver, something in the neighborhood of 200 times the amount of silver that is available for delivery is traded every day.
Correct.
What could possibly go wrong?
Confidence disappears long before a financial system officially breaks, and trust is becoming the scarce commodity. According to Andy Schectman, physical delivery increasingly matters more than paper contracts, because ownership without reliable settlement eventually loses credibility. If leverage remains dramatically higher than available inventory, investors should question which price truly reflects reality. Institutions prepare for these shifts well before headlines acknowledge them. Next, Andy Schectman reveals why competing exchanges could fundamentally change global precious metals pricing.
And so when you only have one port that sets price, that can happen. Now, you could get a very big squeeze with one entity, but that squeeze would not end or culminate in the COMEX blowing up. It would be cash settled, because the banks, the traders, the big ones own the exchange. And so they're not going to kill themselves. They'll just cash settle and force majeure, which is almost the same thing. But when you have another entity that is setting price for immediate delivery, being naked short in a global market is very dangerous.
Yeah.
And that's why you may see less volatility, greater price discovery, and ultimately it's a very good thing.
Yeah, and tonight I am gonna make sure that we are at 1 hour, because you feel like shit. And
No, I'm feeling better.
Well, you look like shit.
Yeah.
I will tell you.
Could be.
I told you this, and I saw the interview between Daniela Camboni and Keith Neumeyer.
Yep.
And we're big fans of First Majestic, and I know that you're very close with Keith and great respect for each other. He actually mentioned you in the interview.
Did he?
Yeah, I sent your text as I was listening to it.
Love the guy.
But the thing that I found most intriguing about what he said was the metals industry is the only industry in the world that they don't create their own pricing.
Competition changes markets faster than regulation ever does, especially when physical delivery determines credibility. What Andy Schectman is highlighting is that multiple pricing centers reduce the influence of any single exchange and make persistent distortions harder to sustain. That could create more transparent price discovery while exposing weaknesses hidden inside leveraged paper markets. Investors should pay attention to market structure, not just market prices. Next, Andy Schectman exposes why mining companies may have surrendered control over the value of their own product.
Yeah.
And you know, he
I
brought
saw
up
that.
the auto
I did see
industry,
that.
and he said we are the only ones that don't actually create the market for what we make.
Right.
And he's right. I mean, if you look at any industry out there, I mean, mints, refineries,
They set
wholesalers,
their
primary
price based
distributors.
on, right, that's right. And that's the whole concept of hedging. And, you know, that's the whole reason, you know, that there's um, David Morgan, who I respect and love, wrote an article and it's titled, Did the Metals Market, something to the extent of, Did the Metals Market Let Down the Public? And he talks about how people paid high premiums to buy it and got big premium reductions when they sold it. And, you know, he's right, but he has to understand too that the dynamics are what were the perfect storm, massive rise of margin rates into rebalancing of the ETFs into the 2026 allocations by the primary distributors who were taking all the new mint allocations at the same time the public was selling. What was different this run up was that you had a whole swath of people selling, giving in, capitulating. I finally got here, I'm out. Now those people are gone. And so you had massive selling, huge allocation responsibilities by the primary distributors. So they're choking on product with margin rates up 300% with ETF rebalancing that collapsed the market. So the refiners got blown up. The people who didn't hedge, by the time they wrote a check to the people selling before they walked out the store, they were underwater.
Premium collapses often expose liquidity stress long before spot prices reveal deeper market fractures. Andy Schectman's argument suggests recent dislocations reflected an extraordinary convergence of ETF flows, rising financing costs, and widespread retail liquidation, rather than a collapse in underlying demand. Investors who mistake temporary distribution pressures for permanent weakness frequently sell at precisely the wrong moment. Understanding market plumbing matters as much as following price charts. Next, Andy Schectman reveals why dealers can suffer heavy losses even when they perfectly hedge metal prices.
And if you were hedging, your cost went through the roof. And there's so much product coming in, it just created a glut. Now, I've never seen that before. It is the perfect storm. The point is that the next time the market goes up, would it be the same thing? Nobody buying, everyone selling, just the central banks and the speculators doing it? I don't think so.
I don't think so.
So, you know, to his point, he is right. It is scary and it has hurt the market, but it's the market. It's not us doing this. And it's important to understand it's the primary distributors that are the ones setting the market, posting the bids. The dealers like us have so much money outlaid, it's not even funny, just trying to maintain inventory, hedge it, pay everyone, and keep things coming
You know,
in.
and not only that, but I think that we've said it numerous times, and I bring it up because if you take India, for example, who they had recently raised their import tax on gold and silver from 6 to 15%, and the goal was to reduce their imports and support their own currency when oil has increased so much, and it worked, except the premiums have skyrocketed. And just in the last week of June to the first week of July, their average domestic premium on silver went from 10 cents an ounce to over $6.30.
That's this market. The premium is something that has a life of its own, and the dealers can't hedge.
That's what I wanted
And
to
so
bring
you
up.
end up getting eviscerated. So
Premiums can move independently of spot prices, creating risks most investors never factor into their buying decisions. This is where Andy Schectman's thesis shifts from metal prices to market mechanics, showing how taxes, logistics, and dealer inventory reshape real-world costs. Investors focused only on charts often miss the hidden expenses that emerge during supply disruptions. Physical ownership involves more variables than financial headlines suggest. Next, Andy Schectman reveals why even large dealers cannot fully protect themselves from collapsing premiums.
let me just explain one thing to the dealers' defense. we placed a $10 million order for junk silver. And the guy called me back and said, I only want five. We had already bought the 5 million. And that was right before the price collapsed and the premium collapsed. And you're talking a massive loss. And there's nothing we can do about it. Zero. Now, this was everywhere. Good thing that we're a larger company, but this was everywhere.
So to explain it in layman's terms, what Andy's talking about is when we do a trade for any client, if we're buying 1,000 shares, we're hedging on the other side. We're selling 1,000 shares. That's really what we're doing. So we maintain a market neutral stance. But if that same time, if the premium changes, let's say on Silver Eagles, it happens to go from $7 to $5. That's a $2 difference that we are now out. That whether it's 1,000 shares or a million, ounces, we can't hedge that. That's on the company that we're losing. So there's a lot of risk, and huge. And by the way, we are a very large dealership that deals in millions of ounces every day. So, and when it comes to situations like what we saw in January, there are times where we see fluctuations in premium. It could be 20 times throughout the day, and we don't even know it sometimes.
Liquidity can disappear far faster than investors expect, even when prices appear relatively stable. Andy Schectman notes that premium volatility creates an entirely separate layer of risk beyond spot price movements, one that hedging strategies simply cannot eliminate. That explains why reputable dealers sometimes experience losses despite disciplined risk management. Understanding these mechanics helps investors separate operational stress from broader market weakness. Next, Andy Schectman exposes why one overlooked order error became a costly lesson about today's fragile bullion market.
It was my fault. The guy placed an order and then emailed me a correction right after. I didn't see it. I had already locked in the order.
Got it.
And by the time that I realized it, I couldn't sell it back to the distributor, and the distributor had to hold. The metal was held, and premiums absolutely collapsed, and it was a disaster.
It was, and it's not like we had another buyer on the line for the 5 million of junk.
Because
it's not like
the price had fallen.
Correct.
People were freaking out. It's these are things it's important to. He has a very valid point, and from his perspective, I get it. But there are nuances and more arguments to be made for trying to do the right thing, but being a victim to the marketplace and to the primary distributors who more or less set the market.
Yeah.
One operational mistake can become a multi-million-dollar loss when liquidity evaporates and premiums collapse simultaneously. According to Andy Schectman, the bullion business carries hidden risks that rarely appear in public discussions about precious metals investing. Market infrastructure, distributor policies, and timing often matter as much as the underlying price of gold or silver itself. Investors who understand these mechanics make better long-term decisions.